Just a minute. Hello everyone, can you all see me? Good evening.
Yes, good evening.
Good evening. Asimbe, Himali Seth, Jaspreet Kaur, Kalyani, Rachna, Sanjeev, Shreya, and Zydus. Yes. Good evening all. And today we are going to have the second part of the AR accounts receivable demo for the CPA course. Okay. In the last class we had the first part. This would be the second part. Fine. Are you all ready?
Yes, thank you.
Yeah. Right. So what are we going to do here? So last part I gave you an introduction of what is an accounts receivable, right? So, and why it is a necessary evil. Sometimes we need to be having accounts receivable even if we don't want it. We don't want to sell on credit, really. Okay? So, because the main reason is people don't pay, right? The simple reason that we don't want to sell on credit is eventually when time to pay up comes, they don't pay. Fine. So we'll have to create provisions. So still we do sell on credit. The reason being we will get more sales, right? So if you don't get credit, the customers would take their business elsewhere. Okay. So giving credit becomes an important part, okay, of the business. Okay, right. Like they say, credit is the lifeblood of the economy. So it goes on. A lot of credit goes on in the business world. Now, once we are given credit, what we are going to do is find out different ways of providing a provision, okay, for bad and doubtful debts. Now, last class I have given you an introduction of what and how we would pass the provision entries, okay, how we would do a write-off once an accounts receivable is actually not going to pay. What is the entry we make in order to write it off? Okay, so I don't know. I don't think it's the same crowd here who is attending the second part. I am not audible, but my mic is on. Can everybody hear me? I forgot to ask you this basic question. Can all of y'all hear me?
Yes, we can hear you.
Sir, I can.
Yes, everybody can. So Kalyani, you're the only one who cannot hear.
But your voice is breaking actually.
Okay, it is breaking. So Avik says my voice is breaking. That might be an internet issue, but I just had a class in the morning, so I know that until evening, until 5 o'clock, I was in a class, and they could hear me perfectly. Okay.
Me too. I can hear you perfectly.
Yeah. It's a question of internet.
Yes.
Okay, on the receiving side. So if you all can hear me, that is good. Okay. So anyway, I don't think the same crowd attended the first part, right? They all may be a different group altogether who is attending the second part. Any case, I may not repeat my first part. Okay. I'll carry on with my second part as if you guys have attended the first part, but with a brief revision. Now, can anyone tell me, once a provision is created, okay, how would you write off a bad debt? For example, when you create a provision, your entry is going to be debit. By the way, I'll write debit as DT. Okay, debit bad debt expense. Let us say expense. Handwriting, pardon me. Okay, credit bad debt expense. Let us say 1,000. Okay, and credit allowance for bad debts 1,000. Okay, this is the provision entry. It's based on an estimate. This one will hit the income statement or your P&L. Okay, now in the US CPA course, there's going to be a slight change in terminology. We never call it a P&L. Okay, P&L is generally associated with IFRS. Okay, and Indian GAAP. So in India we call the profit and loss account. There they would call it the income statement. So mostly the terminology for profit and loss account would be income statement. And then this would hit the balance sheet as a contra asset. Now what do you mean by contra asset? If you have got AR as, let us say, 10,000, accounts receivable shown in the balance sheet as 10,000, the allowance for bad and doubtful debts, even though it's a credit item, would appear in the asset side with a minus sign just below the receivable. So allowance for bad debts would come in like this, and you would show the net accounts receivable as 9,000. Okay, so having done this, then what would be the entry when they are actually not going to pay? Now this was done based on an estimate. This entry was done based on an estimate, based on past experience. Okay, now when they actually don't pay, what would be the accounting entry? Can anybody tell me? What would be the accounting entry? I think Dore, you had attended the last class, if my memory serves me right. Okay, I don't know who else. I clearly remember your name, Dore. Am I right? You had attended the last class, the last demo class which we had. Hi Sanjay. Sanjay Ramchand, hello.
Excuse me, what is your question, please?
Yeah, if the accounts receivable doesn't pay, okay,
Yes.
we have to pass an entry based on an estimate.
Yes.
Okay, that debiting bad debt expense, crediting allowance. Now this is just an accrual entry, you can say. Okay, getting prepared for any real bad debts to come. Now actually the receivable is not paid. Okay, then how do you pass the entry?
Thank you, Boki.
Mr. Vikas, can you please put off your video and mute your audio, please? Okay, I can see you.
Good evening, sir. Sanjay here.
Hi Sanjay. How are you?
I'm fine, thank you, sir. How are you?
Good.
Happy to have you back in the class, sir.
Okay, thank you. Okay, so actually they don't pay. So you made an estimate. So the allowance accounts looks like this. I'm drawing a T for the allowance. Allowance for bad debts. It has by bad debt expense, a credit of 1,000. Now actually 1,000 worth of debtors don't pay. So what would be the entry? You have to write it off. You have to now remove it from the books. You have to remove the accounts receivable from the books. So how would you do that? I did with this in the last class. Yeah, tell me.
Write off account.
Yeah, write it off. You have to write off $1,000 now. How would you do that? So first of all, you would credit accounts receivable. Okay.
Yes, exactly.
You remove it. So you have to credit an item, credit an asset to remove it from the books. And you debit the allowance for bad debt. 1000. Okay. So you got an entry here to AR 1000 and the allowance account gets closed. Okay, I mean it becomes 0. Then you'll have to make another provision because you've used up this provision.
Yeah, sorry for the interference.
Pardon?
Sorry for the interference. So, how are you creating this allowance for bad debts account?
Yeah, as I told you, it is done based on previous estimates. No, previous experience. Probably, yeah. There are two types of providing bad debts. One is a percentage on sales. Suppose you had a credit sales. Of course, only credit sales is going to be provided for. Credit sales, that is you sold on credit, let us say 10,000. And past experience tells you that 10% of it do not pay. Okay. The historic experience. So you are just prepared for it now. So as you know, looking forward, looking a bit ahead of time, you provide a provision by debiting bad debt expense and crediting allowance for bad debts. Is that clear?
Okay. Fine.
Right. And when you write it off, this is the way you write it off. Okay. Right. Then I had also told you that once you write it off, your allowance account would look this way, is it not? Allowance for bad debts. Okay. You had 1,000 here. Okay. A credit. Then you wrote off. And let us say, once you wrote off, 500 of this written off debt eventually pays up. Okay. Now see, once you write it off, even though you have written it off in the books, generally what happens is a court case goes on. You take them to court, okay, and try to make them pay as much as they could, right? So ultimately, let us say this particular customer whom you wrote off pays up. Let us say he pays up 500. What would be your entry? If he pays up, so 1,000 which was subsequently, was previously written off, subsequently pays up $500.
Bad debts account debtor to accounts receivable.
No. Again, you're creating...
Allowance. Bad debt. Allowance account.
Allowance account what?
Credit. Allowance for bad debts. Allowance for bad debts is debit.
Debit? No. Not a debit.
Sorry. Credit. Yes. You have to reverse no entry.
Correct. So what we do is, you will debit AR. Previously you had credited AR, is it not? Now you debit AR. Bring them out, like dig them from the grave.
Correct.
Okay. I call it digging them out from the grave. Okay. Debit AR, credit
accounts receivable.
Allowance. No.
Debts.
Debited AR. AR is accounts receivable. Okay. Credit allowance for bad debts. 500. Okay. So you revive them. So basically, by AR, you're going to get a 500. Okay. And then you have got it out. Now receive the cash. Debit cash, what they are paying. And credit
accounts receivable.
Yes, credit accounts receivable, whom you brought out, right?
Yes.
So that guy you will credit again. So that we do this because in the customer statement, when you send the customer statement, okay, he will see the revived entry here with the invoice number. Okay, so that would be 500 and the cash entry with the receipt number. Okay, receipt number 500, and he knows that okay, what he paid has been recorded in his statement. Okay, because customer statements you'll be sending out regularly, is it not? Right? So the customer gets satisfied, okay, what he has paid recently, okay, is been recorded in his statement, it is showing up in his statement. After that, you do have an excess allowance here. Okay, now here it's a matter of the company's decision what to do with this allowance. You either write it back. When you write it back, you're going to credit bad debt expense, or you put it to a bad debts recovered account in the other income category. Okay, right? Or you just leave it there. If it's a small amount, you just leave it there because there's always going to be movements. There'll be more debts who are not going to pay. Okay, so this provision would be already provided for. You don't have to debit provision account, a bad debt expense account again. Okay, so the entry, just in case, I will show it to you. If it's a big amount, you would prefer to write it back, this excess provision. Okay, so what will be the entry for that? You will debit allowance account. Okay, allowance for bad debt account, you will debit for 500 and credit maybe bad debts recovered 500. This will go in the other income category. Okay, other income category in the income statement. Okay, you can do that. So that way, 2 bad debts recovered, 500, the account gets closed. Closed means it becomes 0. Then you start passing the provisions again. Is that clear? Clear, everybody? Any questions? Any questions so far?
None. Thank you.
Okay. I don't want it to be a one-way traffic. There should be interactions. Okay. So when the classes eventually do start, okay, I would expect the same kind of interaction. Okay. Okay. Today is the first class. It's a demo class. So I don't expect you all to be ultra active here. So what you can do is, once the classes do start, it's a CPA course. You have to get your doubts very, very clear. Okay, there shouldn't be any doubts rather. So you should have a lot of interaction with me. Fine? We should get on that way. Even after the classes, there should be interaction. I don't mind it, absolutely. Okay, now, there are 2 ways of providing for provision. One is the percentage of sales method. There can be more than 2 ways, but mainly the CPA, the 2 ways which are being dealt with are as follows. Okay? Okay, how can we interact after class? I will give you my email ID. I will give you my telephone number. Okay? And I will give you a certain time of the day where you can call when I'm not in a class actually, because I do take other classes. Okay? So at that time, and also I do work as well. Okay, so when it is not in those times, you can certainly call me, and I'll give you my email ID for you to send your doubts to me, and I can do that same question which you have a doubt in, which you cannot solve in. I can do it in the next class when we meet. Okay? Okay, Chris? Okay, that would be done when we actually start the classes. So now, percentage of sales method is one of the ways to provide for bad and doubtful debts. Okay, and the other one is percentage of receivables. So I'll just show you a brief of how these 2 methods work. Okay. The first one, percentage of sales method. Okay, so what do we do here? Of course, goes without saying, only credit sales are taken. Okay, so if credit sales is going to be, let us say 100,000, just giving you an example. And past experience tells us that 10% of it generally do not pay. Okay, so 10% of sales do not pay. So we are going here mainly concentrating on sales. Okay, so that works out to be 10,000. So we do pass this entry. Debit bad debt expense 10,000 and credit allowance account 10,000. Okay, so then in your income statement, among other things, there will be many other debits, but I'm just showing you only the bad debt expense here so that you can see it clearly. Okay, sales is a credit, item. So this would be a debit. It's going to reduce your income by 10,000. Okay? Fine. And then you would show 90,000. Of course, it won't be 90,000. You would have various other expenses as well. But I'm just assuming that you don't have any. And this bad debt expense would be shown like this. Okay? Clear? So far. So this is basically on the percentage of sales. So it's a perfect match where the income statement is concerned. There's a matching of expenses and related income. Okay? So the convention of matching is followed to the T here. Okay? Perfectly followed. Fine. So even you see your allowance account would be like this. Allowance for bad debts. You are just going to pass this entry and be done with it. Okay? You're not bothered exactly how much balance is there in the allowance account. Okay? There might have been a debit of 500. So then you'll pass this 10,000 and now you'll have 9,500 as a credit. Okay? This debit of 500, how would it come? By a write-off. Generally, the debits to the allowance account would come with a write-off. Generally. Okay? Got it? Under no circumstances, the allowance account should be having a debit balance. When you are going to close your accounts, if your allowance account has a debit balance, rest assured that you will lose your job as an accountant. Okay? Do you agree with me? That's a total disaster if your account's allowance account has a debit balance. Okay? They will say that you're not even competent to be an accountant. So be very careful that when you close it eventually, when you're giving your final results, see that the allowance account does not have a debit balance. If it has a debit balance, it means the write-offs are more than what you are provided for. So you should be doing something here. Okay? You should either make it zero or provide an extra amount so that you eventually close it to the credit balance. Is that clear?
Yes.
My personal experience, I have worked in the accounts department all my life. Okay? So in charge of the finalization as well as to take financial decisions, preparing statements for the bank, projections for the bank, etc. I have never used the percentage of sales method. I have switched about 3 companies during my lifetime, okay, of 20 years of experience. None of these companies followed the percentage of sales method. Okay? Many of them do follow the next method, which I'm going to tell you. What is that? Percentage
On the sale.
of receivables method. Do you agree with me? Many people here also must be working in the accounts department, right? So you also must be following the percentage of AR method. For that, we get an aging report.
Yes.
Yeah, every company generates it. Nowadays you don't do it manually, of course. It's all computer generated. Okay, wherein the aging report would look something like this. You will have your current debt, which is less than 30 days or less than the credit period. Then greater than 30 days up to 60 days, there will be one column. Okay. Then greater than 60 days up to 120 days. Depends on how the format is with each company. It might differ. Okay. And greater than 120 days and up to 360 days, there would be another column. And greater than 365. Okay, let us say greater than 360 days, there will be the last column. This gives you how old a particular debt is. Okay, suppose you have got a debt, customer 1. I'll call him customer 1 with a debt of, let us say, 1 lakh. 100,000. Okay, we don't say 1 lakh in the US.
100,000.
Yeah, it will be 100,000. If you say lakhs and crores, nobody will understand you. Okay, eventually if you get into a multinational company working abroad, nobody will understand your 1 lakh or 1 crore. Okay, we'll have to say in thousands and millions. So out of this 100,000, which is the total debt. Maybe the current amount is 50,000. Okay. And somewhere greater than 60 days, there is a 25,000. Just giving you a rough example. And then one particular debt, which is quite old, is 25,000. Okay. Then there is a customer 2. Let us say he owes the company 200,000, out of which 150,000 is current. Okay. That is less than 30 days. Then he has got 10,000 in this range, 120 days to 360 days, and the other 40,000, which is very old. Okay. Like if there be several customers, the company would have a policy. Okay. This would total everything. The report would total each column. Okay. And show the balances of all the customers. Okay. Generally, we shouldn't have so many customers dating so old. Okay. So now here we have 65,000. Now the company would have a policy that if it is current debt, there is no provision. Okay. Nothing to be passed because they will pay eventually. If it is greater than 60 days, maybe there is a 25%, no, greater than 30 days, maybe a 5% provision. Okay, anyway, there's nothing in this column. Then here it is like, say, 25% provision. And here there is a 50% provision to pass. I'm telling you, this is no hard and fast rule. It depends from company to company. Okay. If it's a bank, they might be more strict with the provisions. Okay. Because the auditors demand that, any non-performing assets, as they call it, should be provided for in full. Okay, so their policies might be different. So these provision percentages are not given by US GAAP. They are at the discretion of each company. Okay, depending on the nature of their business. In our company, what we used to do is anything over 360 days, we used to provide for in full. Okay. Right. Just make a provision for full because the older the debt, the lesser chances that they are going to pay because they have either misplaced the invoice or they are not satisfied with the performance. Maybe some goods were not delivered even though you have invoiced them. So it's sort of disputed. So it's obvious when they waited for so long that they may not pay at all. So you provide for in full. Okay. So if you make a calculation, how much will be your total provision? So here, no doubt, it will be fully 65,000. Here it will be 5,000. And here how much is going to be? 25,000 into 25%. So you will have 6,250. Your total provision is going to be how much?
70,650. 250.
76,000. Am I right?
Yeah, 76,250.
76,250. This would be your total provision. Now remember one thing, when you're doing on a percentage of AR method, this is a balance sheet approach. Now percentage of sales method was an income statement approach. You're concerned with the income and the suitable debit balance for that. I mean the suitable expense amount for that. So
can I interrupt here, percentage of sales method, that is we consider only for the sales returns, no? Actually, that's not for receivables, actually.
No. It is for receivables also.
And also, as per US GAAP, I think we have to consider also the sales returns.
Yes. That will come to that later. See, there's a separate chapter on sales returns.
Okay, thank you.
Okay, that how to do it. Do you recognize the sales, a returnable good in income in the first place? So all those rules are separate for that. Okay. Yes, we do provide a provision for sales returns. You're quite right. Okay. But here we are not talking about that part. We are talking about only the people who are not going to pay. Okay. You're estimating and providing an amount for that. Fine. So now percentage of receivables method is a balance sheet approach. Here the approach is not so much as getting the income statement figures correct. Okay. Not a perfect match. You're not looking for a perfect match for the income what you are showing. Here you are looking at valuation of the receivables in the balance sheet. You want that to be as accurate as possible. Okay, fine. So basically your AR, you want it to be showing like this in the balance sheet. Just a minute, I will show it here, this corner. Your balance sheet AR would show the total of these two amounts. Okay, so that is 300,000. Okay, so that would come there. That's the total AR. Okay, 300,000. And the allowance for bad and doubtful debts, a contra entry, should be the provision which is required, 76,250. Okay, and you'll show the net AR. So the net AR is going to be 223,750. This is the way you would show it. Ultimately, it should come that way. Okay, is that clear? Now your allowance account, whatever be the balance, you should ensure that 76,250 remains in this account. You might have a debit balance here, eventually what you might have written off. Okay, I mean previously written off balance, maybe it is 10,000 AR which you have written off. Okay, so now you don't blindly pass 76,250. You would put this as a balance carried down. You need a balance of, the closing balance should be 76,250, come what may. Okay, so you will pass an entry. How much will you pass an entry? By bad debt expense,
66,250.
By bad debt expense, no, you will pass 86,250. So that ultimately you will have a credit balance of 76,250. You understand? 86,250 is credit, 10,000 is a debit. So the balance carried down, this is your closing balance. That would be 76,250. So whatever required provision, you will put it as balance carried down. Okay, that should be your allowance account balance, and then pass the adjusting entry to bad debt expense. So what would be your bad debt expense entry? Anybody would tell me? What would be your bad debt expense entry in this case? Percentage of sales method and percentage of receivables method.
Provision for doubtful debts account deducted bad debts account.
Bad debt expense account debit 86,250. Credit allowance
for bad debts.
86,250. Okay. Why? Because see, 76,250 was required. Okay. So in your allowance account, allowance for bad debts, first of all, what was required as per the aging, you put that as the balance carried down, means that should be the closing balance. Okay, 76,250. Okay, and here we had an entry.
10,000.
Okay, where sometimes we had written it off 10,000. So you have to adjust the account in such a way that ultimately it has this balance. Okay, so by bad debt expense 86,250, and now we will definitely close with this balance. So in the next period you will have a credit balance of 76,250. Okay, this balance carried down would become the balance brought forward, is it not? Is that clear?
Yes.
Okay, so now having told you this theory, it's generally not sufficient for you to get the mastery of it. It's a little tricky. This accounts receivable, let me tell you, the provisions for it, unless you are working in an accounts department, it's my experience that students find it a little tricky to understand this, especially the difference between percentage of sales and percentage of receivables method. Okay, the two different approaches. Fine. So unless you do a lot of questions, you won't get the hang of it. So what we are planning to do now is give you some questions to practice this concept. Okay? So here goes. So first question I'm going to give you. For that, I'll share my screen. Okay? Tell me if everything is to be seen when I do share it. Okay? What do you all see here?
That.
Yeah, that's my cat. Okay? Enjoying itself in the lawn. Fine. Okay. Now you saw that. Now let me show you some of the text which I'm going to show you. Okay? Actually, I'll share a question bank. And in that, I will show you some questions. Okay, I have questions from different exams. Okay, so I will just show you any of it, but eventually I'll be showing you the CPA questions as well. Okay, so Control F, Fiddler, F-I-D-L-E-R. Okay, last demo class we did question number 21. Okay, we had done that already. So let us do this one. Question number 22. Oh, everybody can see question number 22?
Yes.
Yes. Go ahead. Read the question carefully. Okay. This is, let me assure you, CPA standard. Okay. Nothing less. So please read it and try to answer the correct answer. Okay. I'll give you some time. I'll give you some 3 minutes to solve it. I'm timing you. 3 minutes. Somebody's mic is unmuted. Please mute it. Thank you.
The answer is B.
Answer is B for Bangalore.
Yes.
Who is this speaking?
This is George.
George. Your name here is Zydus, is it?
Yes, sir.
I like that name. From where did you get it?
Actually, that's my laptop. Is the company's laptop, so that I cannot change the name.
Okay. That's your company's name, is it?
Yes.
Oh, I thought that eventually if I open a company, I'll name it Zydus. It's already done.
That is, you can't take it.
Okay, that's a nice name actually. Anyway, your answer is correct. Okay, but let us give some time for the others. Yes, Chris Sandeep has told that it is B. Okay, B is right. But I'm curious to know how you got the B. Okay, so that's the main thing, because it can be a lucky guess.
No, it's actually actually what we have discussed just now.
Correct.
The segregation has been given under 60 days, $730,000. So 1%
Correct.
will be received, and 40,660 will be received, and so that and also there is a debit balance of 14,000 is there, and together it is $43,320. Yes.
Correct. You get it. Okay. Now tell me one thing. What is the required provision as per the aging report? What is the required balance as per the aging report? If you have done this, 730,000 into 1%, this is the policy of the company, is it not?
Yes. 29,300.
Correct, Chris. You're right. Correct. You're right. So this one, So this one, all this together. For people who want to do it fast, you just multiply 730,000 into 1% and put it in memory plus. But see that your memory is clear. Okay, this I'm just spoon feeding you all a bit, because some people, I don't know the entire crowd, there may be some people who are from different backgrounds. Okay, I'm just telling you how to speeden up the calculation. So 730,000 into 1%, 40,000 into 6%. Keep on putting it in memory and recall it. So you don't have to add all that back up again. So you will get 29,320. Yes, you're right. That is the required provision. So what you do, you have an allowance account. Okay, an allowance account. Allowance for bad debts. You would put this balance as the balance carried down. To balance carried down. Ultimately, you need to have 29,320. Okay, 29,320. Fine. There's already a debit balance. Now, debit balance just doesn't come by magic. Okay, it would come as, probably it's like this. Probably you certainly wouldn't have had an opening balance as a debit balance. Remember that. Okay, you might have had 20,000 as provision, and eventually you would have written off 34,000. So this is how the debit balance would have come. Okay, it wouldn't have been an opening balance. You understand? So this is how a debit balance would have come. So for the moment, let us assume that the net debit balance was 14,000. It would have happened like this: either 30,000 and you wrote off 44,000, or 100,000 and you wrote off 114,000. Any of those combinations, it could have happened. Okay. Then what you do? You close this account, and you have how much? 43,320 as the total, is it not? Fine?
Yes.
Yeah. So 14,000 plus 29,320. Yeah, 43,320. So by bad debt expense, 43,320. Yes. Make it equal. So what would be the balance of this account? What would be the balance of this allowance account? Can you tell me? Yes, it will be 29,320. Because you see, that's what we wanted to assure, is it not? That it is 29,320. Okay, so yes. Now, guys, I'm going to put you to a test, a different thing. You answered the question correctly. B is the right answer. Now, tell me, what is the journal entry that you'll pass? That's the adjusting entry. That's what he has asked you, right? The adjusting entry to the allowance account. Give me the adjusting entry, debit and credit.
Bad debts account data 2, allowance for bad debts.
How much? With amount?
29,320.
No.
43,320.
Correct. 43,320 you'll be passing. You understood Zydus. I like to call you Zydus only. Okay. Debit bad debt expense. Okay. It keeps vanishing sometimes. This is a Webex issue. Okay. So I have to write it again. Yes. Debit bad debt expense. Oh God, it's going on vanishing. 1 minute. Last time I will write it, then I will go back to the whiteboard. In the whiteboard, it doesn't vanish. If I write it on any other medium, it vanishes. Debit bad debt expense 43,320. Not to AR, to allowance account, credit allowance for bad debts. You are not writing off anything here. Okay, allowance for bad debts 43,320. So this is the entry you'll pass. This would hit the income statement, and this would be a contra in the balance sheet. Okay, it will go to the allowance account. Okay, it will go to the balance sheet. Now, my next question. In the balance sheet, how would be your presentation? What would be your AR? Okay, what would be your allowance? And what would be your net AR? If you tell me this, I'll be very happy. Can you tell me?
Sir, AR is the 29,320. Allowance is 43,320.
No, sir. Everything wrong. Sorry. Everything is wrong.
We can add up all that amount, right?
Up to you. Tell me the result.
18,000.
So what Chris is saying is right. AR would be all this amount.
860,000 is AR. Let's
very nice.
43,320 is your allowance.
No, sir, you are wrong.
29,000. 29,320.
Yes. Allowance is 29,320.
29,320.
It has a closing balance of 29,320.
Yes,
you balance 43,320 to make it 29,320.
Yes, balance would be 830, 680.
29,320. And the balance, the net balance should be how much?
830,680.
Yes. That is sense. Okay. 860,000 minus 29,320. Okay. You are going to have 830, 680. Got it? They can ask you any of these. Okay. They will ask you what is the net AR as a variation to the question. Or they might ask you what would be the closing balance of the allowance account. Then this would be the answer. In this question, they asked you what's the adjusting entry. So then this is the answer, 43,320. Okay, there can be various variations on this question. If you know the concept very well, you can answer it. Understood?
Yes.
Yeah. So this is one of the types of questions that they might ask. Okay, this is based on receivables. Percentage of receivables method. Okay. Now what I would do is give you another question. Okay, depending on the time, of course. Yeah, time you have a little less. Supposed to be a 1 hour class, I think. Am I right? Baswati, are you there? Anybody in the admin here? How long can I trouble these people? Right? In fact, we are enjoying ourselves, is it not? I think some of you guys are working in the accounts department. Pardon? Okay, Kalyani is saying please continue. Fine, very good.
Your trouble is good, sir, to us.
Very nice. Okay, now this question, look at it carefully. There are no choices here. Okay, there are no choices. You have to give an answer. So there is no question of guessing. You have to now calculate percentage on sales method, the allowance. Okay, right. And what else you have to calculate? Calculate the ending balance in the allowance account and the amount that is charged to the bad debt expense using the following methods. Okay, right. Here there are both the methods. And there are beginning balance and transactions during the period. Have a good look. I will not go on talking and disturbing you. In fact, I'm going to mute my mic now and help you concentrate. Okay? So please concentrate and do this. I'll give you sufficient time. 5 minutes? How does 5 minutes sound? Generally, I would give you only 3 and okay. The first case would be balance in the allowance account. Is it? Is that figure your balance in the allowance account? Yes, it's correct. It's correct. But what would be the debit? What would be the bad debt expense account? That also they asked you, right? What is the charge to bad debt expense? Also correct. Also correct. Okay, so Chris has answered both correctly. Now the percentage of receivables is the trick. That is what everybody finds it a little difficult. Okay, try to get that. I'll mute back my mic.
Outstanding receivables is 6%, $300.
Zydus, just mute your mic, and when you want to speak, unmute it and speak up. Okay? George. Thank you. No, Chris, it's not correct. It's not correct. 555 is not the right answer for that. Try again. Try again.
855.
No. No. I'll give you a hint. For that, first thing is you have to find out the receivable balance. Okay, balance in the receivable account. On that closing balance, you have to calculate 6%. And that would be your provision required. Okay. That won't be a bad debt expense. That would be a provision required. So I'll give you a little more time and then I'll be starting off. Unfortunately, all the answers are not correct.
Is it $300? No.
No. No, Dore. No. Okay, let us start. Okay, we don't have time. Otherwise, I could have given you more. Even in the class also, when the regular class starts, I'll be giving you maximum 3 minutes for a question because the CPA questions, syllabus is vast. Accounting is being done so deep as if there's no tomorrow. Okay, each topic they go from the roots to every single detail. So I may not be able to spend so much of time, in the sense giving you a lot of time to answer a question. I'll be giving you a little time and then solve it myself and move on. Okay, the sessions would be recorded and you would always refer to it. And if you still don't understand, I told you, I'm available even after the classes. Okay, so you can contact me and get yourself clarified. Now, first of all, the first part is quite easy. The percentage of sales method. You take the sales and pass 3% on it. Finished. It's an income statement approach. Talking about, basically its focus is to get the income figures right and a proper matching of revenues and expenses. So here it is 1,800. Am I right? Am I right? Is my math right? Yeah. So then, she wants you to find out two things here. Amounts charged to bad debt expense and the balance in the allowance account. Now that part you should take into consideration. I will draw up the allowance account, a T account. Always make a practice to draw T accounts. Okay. Allowance for bad debts. Even at work. Just put a T account when you are in some kind of a dilemma. Okay. Pass the entries. I've been doing this for a long time, even at work. Okay. Right. And that's what distinguishes a professional from a guy who is not a professional. Okay. You will see that all the professionally qualified people would be drawing T accounts. Okay. It gives a very, very clear picture of the whole thing. Right. Now, you have an opening balance. These are all beginning balances of 750. I'll just put it there. Credit, of course. Allowance would always have a credit balance. Okay. And eventually 1,000 was written off. So 2 AR, 1,000 was written off. This happened during the period. Okay. And now you are going to pass this 1,800. What would be the entry for that 1,800? Can anybody tell me? The entry for that 1,800. Debit what and credit what? Anybody?
Bad debts expenses to the allowance to the bad debts.
Correct. Debit bad debt expense. Okay, the whole thing vanished. Okay, this I told you is a WebEx issue, but no problem. You got the picture. Okay, so I'll put it there. Debit bad debt expense. Again it vanished. My God. Don't worry. When it starts, the class starts, I'll be putting it on the whiteboard. There it doesn't vanish. Debit bad debt expense. How much? 1,800. And credit allowance. 1,800. So the allowance account would look this way. It has 750 balance. You wrote off 1,000. You have a credit of 1,800 now. What is the credit balance? When the credit side is more than the debit side, you have a credit balance. So how much is the credit balance? So 1,800 plus 750 minus 1,000. Okay, so your credit balance would be 1,550. That is the answer. Okay, I'm just putting the credit balance. Okay, I didn't close the account. I didn't put balance carried down, etc. Just showing you the credit balance. Is that part clear? Is this clear to everybody? Sandeep, Chris, Sandeep, I know it's clear to you. You gave me the answer in the first place. I'm asking the other people. Any doubts? It's a demo class, no doubt. But still, I would like you to go with a clear mind. Anybody here? Any questions? Clear? Okay. Now we go to the next method. So now for the percentage of receivables method, you have to pass 6% of outstanding receivables. For that, you have to drop the receivable account in the first place. Okay, so now the AR account is drawn. AR account is drawn. Okay, then I'll draw the allowance account as well. What is the opening balance? Can anybody tell me? Yes, 10,000 is the opening balance. So I put it here. That's fine? Okay? Chris is saying immediately no. He said immediately no. Yes, an AR would have a debit balance. Okay, so I purposely put it there just to see your reactions. Okay, AR is an asset account. It should have a debit balance. Okay, you will never close the accounts, the AR accounts, with a credit balance. Okay, if it's a credit balance, it's something paid in advance. So that should be moved to a liability account. I'll come to all that later as we go deeper. Okay, so 10,000 would be a debit balance. Then what happens during the period? Okay, what happens during the period? You had a credit sale. What is the entry? Now we'll come to the write-off again. Now we'll have the credit sale first. Okay, what is the entry for the credit sale? Can anybody tell me? Debit AR. Yes. And what else?
Customer account.
Debit AR, that is a customer account. AR is a customer account. Okay. Another, and credit sales. Yes, you will debit AR. So credit sales, this is the entry, is it not? 60,000 and credit sales. If it's cash sales, what is the entry? If it is cash sales, what's the entry? It would be debit cash credit sales. Okay, right. So I'm asking you these basic entries. Okay, so here, what I would put is, I will put here 2 sales. Okay, that is 60,000. Got it? Now he also says there's a collection on credit sales. So what would be the entry for that? What would be the entry for that? Somebody can give me? For a collection, it would be debit cash, credit AR. Okay, so debit cash vanished. I'm showing you in the same page because you know the data is here. Okay, otherwise normally I would tell you to take a screenshot of this and do on the whiteboard because of this vanishing problem. Okay, debit cash, how much is that? 55,000. And credit sales, not credit sales, I'm sorry, credit AR, 55,000. So now, how does your AR account look now? I'll post it fast. It had an opening balance of 10,000. It got from sales 60,000. By cash 55,000 credit. Now we'll talk about this write-off. How would you pass the write-off? What would be the entry for this accounts receivable written off 1,000? Can anybody tell me here? Debit allowance 1,000. Yes. Debit allowance account 1,000 and credit AR 1,000. Is it not? So now you have a credit in the AR account and a debit in the allowance account. Okay, I have not drawn up the allowance account here. I would draw it up. Generally, I have to open this simultaneously. Okay, so I would do it later on. I would do the allowance account later on. So now you have got 1,000. So now this one has got an effect on the allowance account. Remember that. All the other entry doesn't touch the allowance account. Okay. So now you finished. Now you find out the balance. You have a debit side of 70,000 and credit side of 56,000. Am I right? What is the balance? 14,000 is the balance. Balance carried down is 14,000. You would have a debit balance of 14,000. A debit balance of 14,000. Okay. 6% of that you should have as the required amount. Okay. 6% of that, 14,000 into 6%. That's the required provision. That is not the bad debt expense. Okay, that's the required provision. Okay. Right? Now, let me open up the allowance account. Now, I'll erase all this. Shall I remove everything? The required provision is 840. To find out how much you will pass as bad debt expense, you should check what else is there in the allowance account. Now, the allowance account, allowance for bad debts, had an opening credit balance of 750. You wrote off during the year 1,000. You remember that to AR, right? What we reflected in AR account. AR credit side was 55,000 cash and this written off entry. Okay. So this gives you a net balance of 250. Yes. That's what he has mentioned there. Okay. Then what happens? You put two balance carried down. This should be the balance in the allowance account. The required provision. Remember? The required provision should be the balance in the allowance account. So you put it as balance carried down there. Then close the account. 1840, 1840 both sides. What is the balancing figure or the plug-in entry which you will pass to bad debt expense? By bad debt expense, of course it vanished. I expected it to vanish. Okay. So how much would you have it? Can anybody tell me? Allowance account again. See this, the vanishing trick what this WebEx is playing gives you a good revision, is it not? I'm putting the balances again. Okay, 1,000. And then what happens? I told you, you have to balance carried down. You have to put 840. You close it, 1840. What is the balancing figure? To make debit and credit equal. Can anybody tell me? $1090. This is the amount you would pass to bad debt expense. What would be the entry? What would be the entry? Give me the journal entry, please. Debit bad debt expense 1090 and credit allowance for bad debts. Okay? 1090. Okay. Now, he has also asked you what would be the balance in the allowance account. Ending balance in the allowance account. How much will that be? Guys, come on, tell me. Ending balance in the allowance account. Yes, to balance carried down, it will be 840. Correct. Now, under the receivables method, percentage of receivable methods, you are going to give me the balance sheet presentation. What is going to be the AR? What is going to be the allowance? And what is going to be the net AR? Remember, that's what they did in the beginning. Now I want in the end of the year. Tell me, please. Remember, we had drawn up the AR account, so you should remember the balance there. It's all vanished. 70,000 is AR is wrong. What is the closing balance of AR? Based on the closing balance, we pass the entry, is it not?
14,000 minus allowance.
Yes, 14,000. Yes, if you remember, it was 14,000. What is the allowance?
840.
Yes. 840. And what is the net AR?
13,160.
Yes. Okay. 13,160 is correct. Fine. Any doubts? Okay. Under percentage of sales method, what would be the balance sheet presentation? At the end, AR, allowance, and net. Can anybody tell me? And the percentage of sales method. 13,160 was percentage of receivables method. Now percentage of sales method. What would be the balance? The AR balance would be the same, 14,000. That won't change. But the allowance account balance is different, is it not? That had a balance of 1550. Remember? Okay. So the balance sheet presentation, for balancing presentation and valuation of receivables, the percentage of AR is the best method. Okay, percentage of sales is always concentrating on the income statement. So you have got now 14,000 minus 1550. That was the balance, if you remember. Okay, you might have forgotten. So 12,000, how much? 450. That would be the net AR. These are the two approaches. Okay. Now, in the class, we would be doing more questions. I've got a lot of CPA questions as well. We would be doing that. Okay. This is all CPA standard. Let me assure you that. Okay. Right. And definitely, we will be working out from the CPA software as well. And for you to get a thorough understanding before moving ahead. Okay. Let me tell you, as time is short, I cannot do unlimited questions in the class. I would be handpicking some selected questions to get you the concept. It will be challenging. I will not select an easy question. Okay. So it would be challenging, and I would move on because it's very deep, the syllabus. Okay. You will have to do a lot of hard work on your own and come back to me if you have a question. Okay. That way you're going to make use of the classes for which you are paying for. Fine. So if you don't trouble me, you are not getting your money's worth. Let me tell you that much. Okay. So it should be a lot of work from your side. And once you work yourself, you'd be interested in attending the next class. You'll be waiting for the next class so that you can get your doubts clarified. If you are not working, your interest also would go down. Okay. So we should be working simultaneously together to see that you get this prestigious golden standard in accounting, the CPA. Okay. So I'll wind up for today. I'm winding up. Any admin related questions about the course, you'll be asking the admin group here. Okay, I just got carried away. I'm sorry. 1 hour, 16 minutes. Okay, all of us got carried away. So I leave it to you. Okay, so anybody here, Kalyani or
So good evening. So actually, Bhashwati ma'am is having a technical error at her end. So I would request you if you can make me the presenter because I have few things to share with the participants.
Okay.
And before
what
that,
do? I'll be logging off now.
So just 1 second. I just want to thank you on behalf of the whole Uplift team for the wonderful session which you have, which you have conducted. And
Thank you.
we are excited to see you in the class, sir.
Of course, I'm also excited. I can see some very well-versed professionals here. Okay? So
Yes, sir.
it would be lovely to work with all of you students. Okay? Whoever joins eventually. Okay? And I'm sure the CPA, whoever is joining, would be very serious. Okay? They are not going to be, I don't have to monitor y'all like high school children. So y'all will be driving me. Okay? So I'm also looking forward for the classes.
Thank you so much, sir, for the motivation. So request you to make me the presenter, sir.
How do I do that? I don't know the technical way. I've always been the presenter. I've never given control to anybody else. Okay? Maybe if I log out, that would solve the problem. I'll just log
So what you need to do is that you need to click on my name and an option will be popping on your screen which will say make me.
Okay. Right. I got it. I'll try. Okay?
Yes,
I
sir.
clicked on your name. Okay. Change role to presenter.
Yes, sir.
You are in control? Right?
It says sharing whiteboard.
Okay, you have the control now.
Okay, I'll just.
Okay, because you see, I cannot share anything. I cannot do anything on the whiteboard now.
Fine, sir.
Okay?
Yes, sir.
Shall I get out?
Yes, sir.
Okay. Thank you.
Thank you, sir. Good night.
Good night. Good night.
I hope everybody is able to see my screen. Can you just quickly text me on the chat option? Fine. Thank you. Thank you, Krish. First of all, I thank you for being a part of this session. So before we wrap up, there are certain information which we would like to share it with you. So now you are about to go with the CPA certification. So this is a small synopsis of the course, like what exactly, how you will be proceeding further with the CPA course. Now, CPA is all about the 3 E's. That is your education, your examination, and your experience. Unlike other professional certifications, there are certain criteria which we need to see when a candidate is planning to go for CPA. So the first important criteria is the education part. we need to see, or rather if I say, we need to make sure the candidate is holding minimum 120 credit points to be eligible for the CPA examination. And how do we calculate this 120 credit points? We will have to see the candidate is holding Bachelor of Commerce and post-graduation, either like MCOM or MBA in Finance. And if he or she is a qualified chartered accountant or a cost accountant, that also makes the person eligible for the course. So the first important thing is the education part. Once the education point gets it clarified, moving to the next step, that is the examination, which is one of the most important procedure for CPA certification. In this case, what happens, all the candidates, before writing their examination, you will have to make sure that your transcripts get evaluation. Please do not worry. Uplift is there to help you at every step of the administration part. We will be giving you the complete guidance to how you proceed with the evaluation. So the entire evaluation process will be taking approximately 4 to 5 weeks, and therefore you can, once you get the confirmation of the state board, you can then move to the next step by booking your exam seat. And the third is the experience. According to the NASBA, the minimum requirement for a candidate to have a finance professional is 2 years. If you're having more than 2 years, so that makes you eligible for the course. So this is in brief, which I'm sharing with you. Once you be a part of Uplift, definitely, as I said, we assure you to provide you the complete guidance, not only in terms of classes, but also in terms of administrative support. This is our contact details. If you have any questions related to class, timings, evaluation process, you can please feel free to mail us or call us on the given number. One thing I would like to say is that since we are all now moving ahead to a professional certification like CPA, so we are there to help each other. And once again, we are there to provide you all the services, and we would be happy to see you as a qualified CPA accountant. So then your batch for the CPA starts from October 20th, that's from Tuesday. The timing would be from 8 o'clock evening till 9:30, followed by the next classes on Friday and Saturday. So please confirm your admission procedure to us by tomorrow to the given email address or the contact number as mentioned. If you have any questions, you can also raise your questions through emails and WhatsApp. Fine. So I would like to end the session out here. And once again, thank you all of you for being the part of this wonderful session. Good luck, and we would love to see you as a CPA student. Shall I end the meeting? Any questions? Fine. Thank you, Krish. Wish you the same. Fine. Thank you, everyone. Good night. Take care. Be safe.